It's important to understand how the system operates, and it's important to explain the functionality of the system as well. And I'd like to do that on this particular video. If you are not listening to this as one of the first videos, you may have heard me say a number of these things that I'm going to say here, but it's important to recognize some of the things that we do and some of the things that we have done, and to understand, I think it's important to understand why we've done some of the things that we've done. The system is a price reversal recognition identification system. What we do is we find cycle highs and cycle lows. Many people may have told you or will tell you that you can't find the tops or the bottoms. Don't bother trying to pick the top or the bottom, and that is completely false if you have good indicators. And that's what the premise was, that when we started out, or at least when I started out in 2007, more than 10 years ago. And the whole idea was not only to find the cycle high and the cycle low and identify that turnaround point, but also to find those stocks that had strength in the turnaround. And so that premise has carried through the entire design and construction of the system that we ended up with. When I started in 2007, I made the decision that I'd trade and that I'd find a better system. I'd enhance a method or improve a technique, or just find a procedure and combine it with something else, and I'd have a system. And I made several indicators each week, sometimes a lot more than that. And it was probably 3 years later when I realized all of my indicator creation was worthless because of the method that I was using to implement that. It's kind of like I found 1,000 ways not to do it. And anyway, the light bulb went on one day, and I discovered how to make effective indicators. And within another year or two after that, or probably not more than a year even, we had patterns and conditions and signals. And by that, what I mean is that we have 22 MFR, market force recognition indicators. They're real fast. Half of them are probably leading indicators, meaning they will, just like momentum is a leading indicator, it will tell you or can tell you something about the next period that you're trading. But even though momentum can be valuable, we don't use momentum because because there's better things to use. And so we have 5 different charts: the price chart, the trend chart, the power chart, the zip chart, and the swing chart. And we have many indicators on each of those charts. We also have a master long-term trend line, which is basically an exponential average that we put together and created the long-term trend line. More importantly, we have the 7 short-term trend lines. Basically, those are 3 groups of 7 lines. The trend trio yellow, pink, blue, and the power orange and green, and the swing red and green. Those 7 lines are drawn wider on the chart. You have the option of setting width of lines at any width you want. Obviously, all the colors are locked because we talk about, zip red or zip yellow, and so everything is by color name. The lines are identified by color name. Or more importantly, the indicators are identified by color name. We have five price barometers: zip, pink, and swing Zion, and the 3 price lines, red, green, and blue. Those follow the price. Just when the price goes up, they go up, period. It's just, that's the way they are. That's the way they've been built. They're all very sensitive. The system has 3 powers: the indicator power, those sensitive indicators that I was talking about, the formula power, and the procedures power. The formula power, after just a year or so of building the right indicators, we started to see patterns. And by that, what I mean is indicator arrangements that would create or would identify expected or anticipated price movements. And it would also do that with decent volatility. Or in other words, you'd get a nice green candle or a nice red candle in that movement. There are pattern types up and pattern types down. There are 23 patterns in each group or indicator arrangement. Some of them are one-line indicators, and the rest they're different types. Many of them are multi-line indicators that create a pattern. And those patterns we then use we take those patterns. For example, you take 2 out of 10, you get a nice green candle. Or you take 10 patterns, and 2 out of 10 of them will be a nice green candle. And the other 8, maybe a couple of them a little red candle, and the rest of them small to medium-sized candles. But why did those, out of those 10 patterns that we took, why did 2 of them have nice green candles? And the reason is that we call it, at least, is that they had good conditions, and they had the 7 short-term trend lines running in the right direction. Keep in mind, the trend trio moves faster than the other 2 groups, the power group or the swing group. Actually, after creating the 3 groups and trying unsuccessfully to mold the short-term trend line into one line, we finally decided, hey, I think it might be better to have the 3 groups. And as it turned out, that was a good decision, because we can, with 3 different groups moving at the same time, we can identify some of those 3 things that we were trying to save, because when we tried to incorporate it into one line, we lost a lot of what we were trying to do. And so, besides the 22 market force recognition indicators, we have those 7 short-term trend lines. And they are the lines that they're slow-moving lines, as I've mentioned before, and they are lines that the trader uses. A day trader doesn't use the long-term trend line. He uses short-term trend lines, and the fast lines, the trend red, green, and gray, are fast. Trend blue, pink, and yellow, which are the trio, the short-term trend lines, they are wide lines drawn in wide, and they are slower lines. For pullbacks and rallies, we deal with the fast lines because we can see those changes immediately. We can pick the tops and pick the bottoms of a cycle. The strength of a cycle change can be identified using 2 methods. The first method is indicator line length, and the second method is divergence. Now, there are literally dozens and dozens and dozens and dozens of types of divergence. There's a handful of different types of indicator line lengths that we use. For example, swing pink is a leading indicator. Swing pink and zip red are the two quickest lines in the system. They move faster, they change quicker than any of the other lines out there. Swing pink, however, even though it moves fast, doesn't move far. Its line length difference is small compared with zip red. Zip red will move 30, 40 points. It'll move 50, 60, it'll move 90 points. I mean, I've seen it go from 5 to 98. And when it does, it tells us something. That really long line, as soon as that line gets over 30, maybe about 35, it really starts telling us a lot about what's coming up. And divergence, even though there are just many, many, many types of divergence, divergence does not tell you direction. Divergence tells you power. And so it tells you strength in the market force or the market pressure that's existing within the stock. Now, you take those two patterns that we found that had really nice green candles, and they had specific types of conditions. And when you mimic those conditions with that specific pattern, you then create a very similar condition, and one which is easily repeated because the conditions are specifically identified. And you can get degrees of conditions, obviously. We might want zip yellow above 30, and it's only at 25 or 28, and so you might have a smaller push than you would if zip yellow was at 38 when it's moving up. So we take those two green patterns, we analyze the conditions with it, then we do that for every pattern that we have, and we determine what the conditions are. Those are listed in the system. They're called rules, the master indicator and pattern identification rules. And they tell you about first of all, they define the pattern. For example, there are named patterns and there are shape patterns. Like shape patterns would be like a BOC, a bottom of a cycle pattern. That's basically a V-shaped pattern with a left leg going down and a right leg going up. You can have right leg W patterns. You can have TOC patterns. You can have high M patterns. You can have a bottlenose pattern. And a bottlenose is something that basically I named. It's a three-line up pattern with the middle line in a low angle movement. And they work both going up and going down. All the indicators are reversal indicators, or all the patterns are reversal patterns. A bottlenose up reverses down. A right leg W higher reverses up because it's a down, up, down, and the down is higher than 2 days before. And so it's going down, but it reverses and goes back up. Now, those patterns, then we pick the good conditions, we identify the good conditions, we only pick trades with patterns and with good conditions. And what does that do? That creates high probability. 2 out of 10 is not high probability. If a lot of people, depending on who you talk to, might say that a high probability would be 50% or possibly 70%, but what we have is above 90%. We can tell you with great accuracy, 95, 97% of the time, which direction that stock is going to go in. Now, don't misunderstand what I'm saying. If there's if there's 100 stocks out there, we're going to be able to identify somewhere between 10 and 30 stocks that will go in a specific direction with strength. We might be able to identify another 10 or 20% and tell you their direction, but we'd also be able to tell you that they don't have any strength and we're not interested in them. And so we're hand-picking the stocks that we want with the pattern that we choose, and then with the conditions that are associated with that pattern to generate a strong up movement in the case of a buy-long situation. And so then that particular pattern that we choose that has real high probability also has what we refer to as signals. We have another pattern, for example, is a red spike, and its partner is a red peak. The red spike is zip red down and under 50 and zip yellow down and above 50. That pattern has great flexibility. That's the rule for the pattern. But I want to tell you this, that zip yellow can go down even under 30 with red at, from 0 to 10, somewhere under it, and still turn around and go up the next day. So the red peak is zip red up and above 50 and zip yellow up and under 50, and it goes down the next day. Those are named patterns. We have pink-green top and pink-green bottom patterns. We have the shape patterns like the BOC pattern, the TOC pattern, etc. Then we have we take this pattern, we apply the good conditions specific to that pattern, and we find the signals. We identify the signal when that pattern will turn and go up. When the bottom of the cycle will turn and go up, we can pinpoint it with a signal. There's a lot of profit left at the table or lost at the table because people do not know how to get in or get out of a position. And so the signal increases the bottom line, we think, significantly. The result of the patterns and the conditions with the signals is the formula power. You enter a high probability trade. If you're following the procedures of the system, you enter a high probability trade every time you trade. You increase your knowledge, you increase your confidence in trading, and when your confidence increases, your whole environment changes. You're happy, you're excited about trading. I mean, when I was developing real estate in Minneapolis for a couple of decades, I loved it. I was having a great time, and I sold homes 20 years before that. I loved selling real estate. It was like it wasn't even work sometimes. When I discovered this in 2007, when I made my first trade, I wasn't happy when I lost, because the very first trade I made, it went up and then for a little bit and then it went down. And so before I got out, I lost money. Wasn't a whole lot, but the point is I lost. My inconsistency in trading was horrible, and I wanted to find a system that I could create that would give me consistency. That was the number one priority that I had. With knowing that I had to be consistent, I had to have a system that would allow me to see which way the market was going to flow for that particular stock the next day or the next period. Along with that, we wanted to have volatility, or good volatility. You don't want to buy a stock that goes up 5 cents by the end of the day. It doesn't do you any good. You need to find those stocks with strength, with volatility, that are going to have a nice big green candle. And so that created the need for strength, and that's how that whole premise evolved into what we were looking for. Eventually, we found patterns that would gap. And we found that 3 of the indicators out of the 23 we could use to find gaps. Those 3 were the identical indicators, the down touches in the trend chart, and the proximity, location, and shape patterns. The identical indicators, we had 22 market force recognition indicators, and we wanted to find at least a majority of them, or in other words, 12 of them in a BOC pattern, or a TOC pattern, or a right leg W pattern. It was some kind of shape pattern that we wanted to find at least a majority of the indicators in that. Additionally, we found out that we could find a pattern, a opportunity to gap up, because I'm going to talk about just gapping up for the moment. When we had those 12 indicators, but they could be 9 BOC patterns and 4 right leg W higher patterns. And that was referred to as a 2-pattern group. The total was 12 or more. Now there are occasions when you only have 10 or 11 and it'll still gap. It may not be as big, but you can, as long as you have the qualifying conditions for a gap, it works. The second indicator was the trend chart. The fast lines are the red, green, and gray lines, and the slow lines are the trio, yellow, pink, and blue. The fast red, green, and gray could down touch the yellow, pink, blue, or the 0, or it could down touch the area under 0 to about the first 20 points or so. It really wouldn't go much more than 20 points, depending on the chart you were looking at. But anyway, the 5th area that I'm talking about is under an area under 0. There's no particular line that it touches, but it's qualified by the day that it crosses underneath the 0, when you have the trend yellow, pink, blue on top of the 0, and then you have the 0 line, and then the red line comes down and goes underneath the 0 in that area, but it doesn't touch anything. But the day that it crosses over is also the signal for the day that it goes, the next day goes back up. Or if you're on the hourly chart, for the next hour, it goes back up. Now, that's the first 5 down touches. The 6th down touch is referred to as a sky touch. And these are basically gaps that occur when you might have 1, 2, or 3, or 4 green little candles, and then boom, you get a gap up. And so when trend red crosses over green, that's the start of an uptrend. When trend red crosses under green, that's the start of a downtrend. And that can happen on the same day. For example, in going up, trend red can do a BOC. It can also cross over trend green on the same day. That's more strength than when you have when you just have trend red do a BOC pattern. There is a difference in the strength in a BOC pattern when the left leg is shorter than the right leg. The right leg, we would refer that as a BOC higher pattern. And a BOC higher pattern is it has more power in the movement than a BOC lower pattern. Also, there's divergent conditions that occur. When you see a BOC higher, or when you see a BOC pattern, you expect it to occur in a BOC or at the bottom of a cycle. But BOC patterns can occur at the top of a cycle, and they occur before or at the top or at the peak. And when you get a BOC higher pattern on a peak, that's divergence, and it's all, what it basically means is that it's overbought. And I'm sure you've all, anybody that's doing any trading understands about being oversold or overbought. And so what we have then is a stock that was pushed up too far, and as a result, the next day it's going to react and go back down or gap down. Or it may do 3-4 red candles, or whatever the case may be. But the BOC higher pattern on a peak is a divergent move, and it just doesn't belong there. And when you see things that don't quite belong there, or when you see one line up and another line down, and these would be like specifically with pairs, like zip red and zip gray as a pair, or power pink and yellow. When those go opposite each other, you got divergence. Swing Zion and swing pink are divergent. But then keep in mind the indicator lines, what the indicator lines mean, because there's text information on defining what they do. For example, zip green tracks trades in and out of the stock, or tracks buyers in and out of the stock. I always say it tracks buyers, but in reality, it doesn't physically track different buyers. It's just tracking trades. So when zip green is at 0, there are a lot of people leaving the market. When zip green is at 100, there are a lot of people getting into the stock. When its grandfather, zip Zion, moves, it's tracking trades as well, but it's moving much slower. When it's at 0, there are a huge number of people getting out. And when it's at 100, there are a lot of people getting in. And so when you combine those two together, when you combine zip green with another indicator like zip pink, which is a price barometer, you then are analyzing the price and the trades at the same time. Those can be uniquely in positions to give you a lot of information. Likewise, the same is true with many other different indicators. And the comparison in divergence is oftentimes made between pairs. Because after we created the indicators, we then identified two that would go together, and we actually synchronized a lot of them, meaning that we tuned them up or tuned them down so that they would run somewhat together. And when they separate, it's a divergent condition and gives us a lot of information. Zip yellow and zip blue will often separate. And when they start to separate, you get big price movements, and when they come back together, again, you get big price movements. And so all of this, you throw all of this together, and we have the indicator power, the formula power, and we also have the procedures power. Now, the procedures power is nothing new. Anybody that will analyze the market or analyze the stock is involved in procedures power. And by this, what I mean is we will take the indicator lines, examine what they're doing, and compare them against the value of the stock and the next day or next period movement of the price of that stock. And so we have an interpretation that we can gain on where those indicator lines are and what they're going to do to the price if and when they move or how they move. And so we analyze that activity. Now, you can do that with your indicators. You can do that with the default indicators at TradeStation. But, and again, I don't know what the percentages are, but I'll give you an example. If you look at let's say 10 different stocks, and you spot one divergent move with the default indicators that, for example, were with TradeStation that TradeStation provides. So we've got one divergent condition out of those 10 stocks on that particular day. With the sensitive indicators, we could have 10. We could have what percentage should I don't know. I haven't tracked it, so I'm searching for mentally how much more they might be, and I really can't honestly answer that because it's been so long since I used default indicators. I don't know how they react, but I do know that we see a lot more divergence, and it could be 20, 30, 40% more than you'd see with default indicators because of the way the indicators are built. And if you haven't seen it, you'll see that I often comment about the indicators being the heart of the system, because without those indicators, we wouldn't have the patterns, we wouldn't have the conditions, and we wouldn't have the signals that give us the formula. And so the indicators are really powerful. And so the procedure power of analyzing those indicators in relation to price movement is the procedure power. It's that analysis, it's that verification, where you verify the conditions, you do that testing, you compare different indicator situations with the price. That relationship of analysis, comparative analysis that you do, is referred to, or what we refer to as the procedure's power. But I think you can see that it's much more valuable with the DTVB system than it is with any set of other indicators. And that gets me to the idea of the difficulties that I had in consistency in trading. And it also gets me to the point of identifying the mistakes that I made. I made the decision that I would trade and that I would find that formula, I'd find that method, I'd enhance it, I'd improve it, I'd combine it, whatever I was going to do, I'd do it. But in my heart, in my mind, I was absolutely certain, and I asked this question often: what's more important, the next trade that you make or the next or the system that you use to find the next trade that you make? If you have a system that is finding only high probability trades, there's a vast difference in your portfolio. Because number one, you have a extremely high probability of knowing which direction that value of that stock is going to go. That's powerful information. And it's done through leading indicators, it's done through indicator line length, and it's done through divergence. We can recognize the power. We pick the one with the most power. And basically the whole system works on the more is better. When you can find more patterns, more leading indicators, more information that will say this price, the value of this stock is going to move up. And see, when you find the patterns, the direction is not an issue. It's just the volatility of the direction that it goes in. And obviously, it depends on your ability to pick the entry point and the exit point. And so you can use these same indicators. You can drop them down to the 2 or 3 minute chart, 5 minute chart. Drop it down to the tick chart if you want. And you can figure out where the bottom is, and you can pick the bottom and enter. And that's the amazing part of this thing. You see, I made a decision to trade and to build that formula, method, whatever you want to call it. But I knew absolutely that I should have stopped everything and found the system. But no, I didn't stop. I traded while I was looking for that system. I mean, I'm good enough to trade and be successful before I find that system. I wasn't. For months and months and months, I was inconsistent. I got a little better as I went along, but it isn't anything like what it is today. Because up until the point that we found the formula of the patterns and the conditions and the signals, there was no system. But I thought I had a system. As soon as I'd create 2 more indicators, I thought I had a better system. And I really just had a couple more indicators. I didn't have a system. And that was a trap that I was in. And this is why I share that with you, because you have to make a decision on what system you want to use. And I firmly believe that we've got the best system on the planet. I know of no other system out there that is able to identify strength through whatever method they might use. They've got some different formulas. There's a lot of people out there that will tell you that my algorithm is great. Just join me and you can use my algorithm, and it works 74% of the time, or whatever percentage they give you. Well, depending on what you got invested, you don't want it to work 74% of the time or 84% of the time. If you can hand pick high probability trades 95 or 97% of the time, 98% of the time, red peaks and red spikes have really high flexibility, meaning the rules of being above or under 50, that's the rule, but they really work far below or above that. They also, just generically, without good conditions, will normally work. The red peaks and red spikes have a very high probability ratio without even throwing good conditions at them. Hardly any of the other patterns are like that. But in any case, you're much better off buying or entering a red spike that's going to reverse and go up when the 7 short-term trend lines are also going up, or at least when the trend trio is going up, because that's faster and it's going to start, that's telling you the start of an uptrend. Even though your fast lines, like your trend red, your power red, your zip red and gray, those lines may still be down one day or possibly another day before they go up. But that now, all of that brings us to the point at which we are trading next day opportunities or uptrends. And when I say next day, I mean a 1-day opportunity, or an uptrend would, in my mind, is like a 2 to 4 day or a 3 to 5 day opportunity, meaning it's an uptrend. You have that type of trading activity. You also have gaps. And as I was describing earlier, you have those identical indicators of 12 or more. You have one of the 6 down touches in the case of a gap up, and you have the proximity location patterns in a particular location, along with shapes of the indicator lines. And these are the same shapes that you find in the identical indicators. It's actually it is the same as what you find. But when we talk about the proximity group, we're just talking about the power 4 or the power 5 lines. If you add red, you're talking about the power 6. If you talk about the power 3, you are talking about eliminating yellow. Because sometimes Zion and yellow will be under power orange, and the other 3 will be over power orange. Sometimes yellow is by itself with the other 4 lines on the other side of power orange. And so there's a lot more locations than there are shapes, but not that many more. Maybe twice as many different types of locations as there are shapes. And there's 7 shape patterns. Depending on how you count, you might count it as 8, but basically there's 7 shape patterns in the proximity group. And so you take those proximity shapes, you take those proximity locations, and you identify them as being somewhat normal for that particular pattern. And then you make sure that you have a down touch in the trend chart with either red, green, or gray. Sometimes you can have all 3 of them. You can have a triple. Red, green, and gray will down touch one of the other color lines, or 0, all at the same time. And so you have a triple down touch, which is often or usually more powerful. Also, the trend pink is the most powerful line to down touch. Trend red can down touch trend pink, or trend green can down touch trend pink. But I think it's because trend pink is in the center, and because the center of the reaction comes down right to the center, it reacts stronger and goes back up. I'm not certain exactly why, but I think that's the reason. And so whatever line touches pink, it usually reacts stronger than it does if it's touching another line. Now keep in mind that is subject to your other information. Conditions. There are 3 types of conditions. You have required conditions, you have good conditions, and you have supporting evidence. The supporting evidence sometimes we'll call extra conditions. The conditions that constitute, for example, a red spike is zip red down and under 50, and zip yellow down and above 50. The down part of it is the condition of the pattern name. Because if you take a red peak, you have zip red up and above 50 and zip yellow up and under 50. And it goes back down the next day. And so the condition of up or down, or you can even say the condition of above or under 50 as well, constitutes a required element to the pattern. And that's what in essence, excuse me, that's what in essence describes the pattern or defines the pattern. And so those are required conditions. The good conditions are like when the 7 trend, short-term trend lines are going in the right direction, or other factors like that. Other conditions. They could be indicator lines going in the right direction, or you could have indicator patterns. Likewise, when you have the extra conditions, the extra conditions are the conditions that we find after, for example, if we say that we have a 2-pattern group, 9 BOC patterns, and 4 right leg W patterns, then those are the 2 main patterns that define the identical indicators. And so If we find another one of those, then we just add it to the list. But by taking a completely different pattern, like say we have both of those patterns indicate price up next day. And they are in addition to the primary requirements of the 3 gap up patterns that we've already established, the 9 and the 4. And so when we find that red spike that red spike, that's a pattern. When you find a complete pattern that is associated and pointing in the same direction as what you've got in the other 2 primary patterns, you've added a pattern to the situation. And that is much more powerful than if you would add, for example, swing pink is up. That's a leading indicator line going up, suggesting that the price is going to be up tomorrow as well. So a pattern is much more powerful than a line. When you have these extra things, also many times extra things will be divergence. You can have red and gray divergent, one up, one down. You can have line divergence in that zip red went up 50 points on the day before the gap. You can have other types of line divergence. For example, we take 2 lines like zip red and zip gray, and they're at 20 and 21. They're 1 point apart. And on the gap, on the day before the gap, they are at 28 and 26. And so what has happened is that, a better example would be 28 and 24. When they started out, they were 1 point apart, and when they ended, they were 4 points apart. And the rule is 3x, or 3 times. You need to get the difference. In other words, we take the difference of 2 lines, which are a pair. That difference, which was 1 point, is compared against the difference the next day. And when that difference is 3 times or more, then that's a significant issue. It's basically a line divergence issue, because one went up much higher, much stronger than the other one did, more strength. And so we're grabbing each of those opportunities that we see strength in, and you only have to have a couple of divergent moves besides your primary, your 3 gap up patterns. Besides those primary requirements that you have to establish them as conditions for a gap, you only have to have 2 other divergent conditions, and you're going to have a much stronger gap than you would if you don't have anything else that supports what the primary patterns are doing. If you've got the identical indicators of 12 or more in 1 or 2 patterns, if you've got the down touch in the trend chart, and if you've got reasonableness in your location, your proximity location patterns, your shape patterns, you're going to have a gap. But by adding more, sometimes, I found situations where I had 6 or 7 types of divergence. Gap up $5, $6, $8. But along the same lines, not every gap has divergence. So it's more complex than you might think, but the information is there. All you have to do is listen to the videos and start taking notes. And what you want to do is throw this information, your trade logs. Every time you make a trade, you throw all of that information into an Excel program, and you analyze every single trade you made. Why did I pull the trigger? What was mentally going through your mind when you pulled the trigger to buy that stock? Those are the things that you want to know, because you're going to go back and look at that and you're going to say, oh, I missed that there. I didn't see this. And then you're going to add another column in your Excel program and you're going to start marking that down. And it won't take you very long where you're going to be very proficient in specific patterns. But you have to track your information. If you do that, you're going to be very successful. The other thing is that if you're searching for gaps, you want to do the same thing in the Excel program with different patterns, or in whatever way you want to do it. You want to track gaps up, track gaps down. You're going to see there's going to be differences when you have a gap up with a sky touch, or when you have a double touch or a triple touch, or when they touch the blue line instead of the pink line, when the trio is under 0 or over 0. There's a lot of elements to it, but as soon as you start putting it together, 30, 40 indicators are different opportunities, you're going to start to see connections. And so then you're going to be able to identify gaps through that, primarily through that method. And as a result of that, you will be able to see when these things gap. And then another part of the system is the radar screen. We have 8 master indicators built. One indicator has about a dozen types of divergence in it, and you can open up that divergent indicator in the radar screen chart, plug in 100 or 300 or 500 stocks. You can go up to 1,000 if you want, and you can look and see. I mean, each one, if it has that condition in it, it's going to have a box color alert. And that box color alert, if you're looking at this symbol here or that stock, and all of a sudden you've got 5 divergent conditions on that line, that's definitely worth looking at, because it's telling you that there's a lot of divergence going on. Go in and see if you got a down touch. Go in and see if you've got 12 identical indicators. If you do, you got the basis of a gap. The other way, and that is just as effective in its own way, is the scanner. We have built, I say we have 400 indicators ready to go, like trend red up and trend red down, all of the basic moves. But all you have to do is pick, power pink up and power blue down, plug them both into a scanner at the same time, and you've got a divergent scan. Or you've got a divergent condition that the scanner will print out all of the symbols with that condition right there. You don't have to build any indicators. And now I've left the number at 400, but I was roughly counting it, and I know there is closer to 600 of those indicators. Ready to go. It's the system you use is much more powerful than the next trade that you make. And we have created a phenomenal system. We can identify the gap before the gap occurs through strength in the indicator relationships, or through line length and divergence. And we can pick that strength up. We can see it on the indicator lines. We can tell you that it's going to gap up the next day or gap down the next day. It's just a matter of finding them in the scanner or finding them in the radar screen. The other master radar screen indicators that we've built are the 6 down touches in the trend chart, and the 6 up touches in the trend chart, but both of them include the 5 sky touches, and going the other way we call it a spike touch because it's just a continuation pattern with a gap down at the end, either on the cross under day or the day after the cross under, or 2, 3, or 4 days after the cross under. Then you get a gap down. And so we've identified all those gap downs, we've identified all of those down touches, all of those up touches. They're called 6 pattern, or 6 down touches, or 6 up touches. We've identified the divergence, as I said. We've put on the 7 short-term trend lines. There's only 5 columns. I've used trend yellow instead of, and not used blue and pink, simply because yellow is closest to 0, both above and under 0. And so when yellow, pink, and blue, when one goes up, they're all going up. When one crosses 0, they're all crossing 0. And so you only need 5 columns. But when you see 5 red boxes, you know all lines are going down. And when you see the white text, you know that the white to me identifies clouds, so you know the indicator line is above 0. If it's got the red text, you know that it's, or dark red text, you know it's under 0. And that's the kind of the basis of how the box color alerts work. And all 8 master radar screen indicators have all the box color alerts listed. They're on the webs. They're in one of the web columns. I think the 3rd column over. So it's a powerful, powerful system. It is more powerful than I thought it was even going to be when I started out. The pieces started falling together much more effectively than I could have made them. When we started out, we did not dream of being able to find gaps before the gap occurred. We were just looking for strength. But we also felt it very important to buy strength, to buy and then we found out through the indicator line length, and there's probably a handful of different ways of calculating indicator line length. And then, of course, there's dozens and dozens and dozens of divergent methods. And obviously, when you've got a market pressure inside of your stock telling you that that's going up, and you've got a market pressure inside that stock that telling you that the price is going down, something has to give, and it pops, and it usually ends up in either a strong movement or in a gap, depending on the level of divergence that you have. And if you don't have for example, if you don't have the down touch in the trend chart, but you have maybe 12 or 14 or 15 identical indicators, it's a matter of degree, okay? That is likely to turn into a uptrend or a really big green candle the next day. I mean, assuming it's that way, But if it had the gap down, then it would be possibly a gap up. If you had the down touch, then it would possibly be a gap up. And so what I'm saying is that if you have all 3 requirements in the 3 gap up patterns, that's going to gap up more than likely. It's not a guarantee, because sometimes you can get that information and end up with a 4 or 5 day uptrend. So we usually identify the gap, but sometimes we miss and we identify an uptrend rather than than a gap up. And so if you start taking stuff out of there, there's not as much supporting evidence. There's not the parts of the 3 pattern. You end up with uptrends or green candles the next day. And so it's just a matter of finding more information, because the more supporting evidence or the more extra evidence that you find, the greater the movement is likely to be. And that's really the essence of how the system works. It has a tremendous ability to build confidence. And when your confidence gets built, you just trade much more effectively. You see things better. You're able to just pick those tops and pick those bottoms much more effectively. And and then when you have what some would say is a super high probability ratio, above 95%, then it just throws everything into more confidence. But it's hard to see. I mean, I call them, I've got a 1 or 2 tapes on traps, and I tell you about my traps and caution you about what you might be stuck in, because that's the difference, I mean, it's pretty easy, relatively speaking. I mean, everybody's got a different budget in their trading account, but it's fairly easy to pay for the system with the first trade that you make in a month. Obviously, it's relative to how much money you're trading, but I think for most that's the case. I think on the first trade, and some people make 5, 6, 10 trades a day. Excuse me. So it's powerful. It's beyond what we anticipated. We have we have tried to effectively convey that information primarily through videos. And the more you see how things operate through videos, the greater your ability is going to be to see how the system works. Because there's kind of like themes that run through the system. I mean, the location pattern, for example, with all 5 above power orange. I mean, that might happen in a dozen of the type up indicators, and in some of the down indicators as well, because there's only so many places for the 5 lines to be above or under orange and in multiple splits. And the only splits you generally get is power Zion is different from the power 4, or power yellow is different from the power 3. And of course you have power red that usually runs really high or really low. Also, I'll comment on exclusions. Like, for example, when you think of power pink being lowest, you don't use power red, because power red, the power lines are also location lines, meaning when they're above 0, they have a tendency to move the price up. When they're under 0, they have a tendency to move price down. And when red, which is the best position indicator that we have, when red crosses crosses the power orange line, that is the best indicator for direction, up or down. When it crosses under, I guess I'll emphasize The power lines cross 0, not the orange line or the green line, in their primary effectiveness. Oftentimes, obviously, red will cross both of them at the same time. But technically, we talk about 0. Sometimes you'll get a stagnant day where power red will cross over 0 just by a hair, 0.2 or whatever it might be. And there'll be a little red candle or a little green candle. And then the next day you get a really big green candle or a gap up. So if you thought you were going to gap up and you end up with a little doji candle, hang on, because the following day things should go up. I call that a stagnant candle. It's just sometimes that occurs. I've pointed that out on a few videos, but sometimes that occurs in the situation. But like I said before, we do not know of anybody that is tracking strength, much less tracking the ability to find gaps before the gap occurs. There's a lot of people out there trading gaps, but what they do is, oh, this one gapped down $5, let's trade it. And that's fine. It's going to be volatile that day, or possibly could be volatile that day. And so it's a logical trade or a logical opportunity to examine. But we pick them before it happens. And we do it through strength, indicator line length, divergence, and pattern conditions, or pattern, I don't know if you want to say specifically locations, but there is a difference in trading, and we have a system that I say obviously biasedly that it's the best system on the planet. But whether it is or not, I can tell you this: we can find gaps before the gap occurs.